If you understand the time value of money, discounted cash flows, how to theoretically price a bond, and the relationship between bond prices and yields, then we can move on to Macaulay and modified duration. If, however, you are not familiar with these principles, then I would suggest you watch the 2 previous recordings in this series, where these are explained. Firstly, we will look at Macaulay duration. Macaulay duration is a measure of the weighted average time until a bond's cash flows are received. It's expressed in years and considers both the size and timing of the bond's coupon payments and principal repayment. Essentially, it gives investors an idea of how long it will take to get back their invested money in present value terms. Macaulay duration is primarily used by fixed income investors, portfolio managers, and financial analysts. It helps them assess interest rate risk and manage their bond portfolios effectively. Institutions that manage large bond portfolios, such as pension funds, mutual funds, and insurance companies, often rely on duration measures. Macaulay duration matters because it provides a measure of a bond's sensitivity to interest rate changes. The longer the duration, the more sensitive the bond is to interest rate fluctuations. Understanding duration helps investors manage interest rate risk and balance their portfolios in response to economic conditions. It also aids in matching assets with liabilities in financial planning, ensuring that cash flows align with future payment obligations. There are a number of steps required in calculating Macaulay duration. 1. Identify cash flows. Start by identifying all the cash flows of the bond, which include periodic coupon payments and the final principal repayment at maturity. 2. Determine timing. For each cash flow, determine the time period in years until it is received. This is simply the year number of the respective cash flow. 3. Calculate present value. Calculate the present value of each cash flow by discounting it using the bond's yield to maturity. This means adjusting each cash flow to reflect its value today. 4. Weight by time. Multiply each present value of the cash flow by its respective time period. This gives you a weighted present value for each cash flow, emphasizing the timing of when the cash is received. 5. Sum weighted values. Sum all the weighted present values from step 4. This gives you a total weighted present value of all cash flows. 6. Sum present values. Separately, sum all the cash flows without weighting them by time. This provides the total present value of all cash flows. 7. Divide and calculate duration. Divide the total weighted present value by the total present value of cash flows. The result is the Macaulay duration, expressed in years. This process essentially tells us the average time it takes to receive the bond's cash flows in present value terms, helping investors understand the bond sensitivity to interest rate changes. To keep things simple, we will use the same numbers as for the original bond valuation. A yield of 10%, a coupon of 10, and a maturity of 5 years. Using these values, we return a Macaulay duration of 4.17 years. If we increased the yield to 15%, then the Macaulay duration falls to 4.08 years. And if we reduced the yield to 5%, then the Macaulay duration rises to 4.25 years. To bring this back to what Macaulay duration means, The higher the Macaulay duration, the greater the interest rate risk associated with a bond. Here's why. Interest rate sensitivity. Macaulay duration measures the weighted average time until a bond's cash flows are received. A higher duration indicates that the bond's cash flows are spread out over a longer period, making the bond more sensitive to changes in interest rates. Price volatility. Bonds with higher duration experience greater price fluctuations in response to interest rate changes. Specifically, when interest rates rise, the prices of high duration bonds tend to decrease more than those of low duration bonds, and vice versa. Risk management. Understanding the duration helps investors assess and manage the interest rate risk in their portfolios. Investors who are concerned about rising interest rates might prefer bonds with shorter durations to minimize potential price declines. In summary, a high Macaulay duration signifies greater interest rate risk because the bond's price is more sensitive to changes in market interest rates. Modified duration. If we now look at modified duration, this is a measure of a bond's price sensitivity to changes in interest rates. It estimates how much the price of a bond will change for a 1% change in yield. Unlike Macaulay duration, which is expressed in years, modified duration is a percentage that directly relates to price volatility. Modified duration is used by fixed income investors, portfolio managers, financial analysts, and risk managers. It helps them understand the interest rate risk associated with bonds and manage their portfolios accordingly. It is particularly valuable for institutions that need to assess the impact of interest rate changes on large bond portfolios. Modified duration matters because it gives investors a clearer understanding of how bond prices are likely to react to changes in interest rates. It is a crucial tool for risk assessment, helping investors assess the interest rate risk of individual bonds or bond portfolios. Portfolio management, allowing investors to strategically manage their portfolios based on interest rate forecasts and risk tolerance. Pricing strategies, assisting in determining the impact of interest rate changes on bond pricing, aiding in buy-sell decisions. The calculation of modified duration is relatively simple. All we need to do is to divide the Macaulay duration by 1 plus the present yield of the bond. The modified duration will then tell us by how much the bond price changes in percentage terms as the yield changes by 1%. If we revert to our original numbers, a yield of 10%, a coupon of 10, and a maturity of 5 years, which gave a Macaulay duration of 4.17 years, then we return a modified duration of 3.79%. This means that if the present yield of 10% increases by 1%, then the bond price would fall by 3.79% from 100 to 96.21. Conversely, if the yield fell to 9%, then the bond price would rise by 3.79% from 100 to 103.79. If the original yield of the bond was 15%, then the modified duration would fall from 3.79% to 3.55%. Whereas if the original yield on the bond was 5%, then the modified duration would rise from 3.79% to 4.05%. To remind ourselves what this all means, the modified duration measures the price movement of the bond should yields change by 1%. The higher the modified duration, the greater the movement in the bond price when yields change. The file attached to this recording will allow you to identify how Macaulay duration and modified duration change as you modify the coupon, yield, and maturity of the bond. By doing this, you can get inside the mind of a bond investor and identify what matters to them when building a portfolio of bonds. If you want to build your credit expertise, your next step could be the Global Credit Certificate. It's designed and delivered by industry experts and walks you through the 4-step credit decision process, making sure you're fully prepared to make informed, strategic credit decisions from the get-go. Visit the website for more information.